webinar. Today, we are very happy to have Professor Duffy as our speaker. Professor Duffy is one of the leading financial economists in the world, and he's the Adams Distinguished Professor of Management and Professor of Finance at Stanford GSB. He's also a fellow and a member of Council of the Econometric Society, a fellow of the American Academy of Arts and Sciences, and a research fellow of MER. Moreover, he's a distinguished fellow of Luohan Academy, who hosted today's webinar. In 2009, Professor Duffy was elected to the president of AFA, and he's also deeply involved in major policy design, such as the reform of Libor, Euro, Euribor, and actively in many policy discussions, as we will see today. Besides academic papers, Professor Duffy also read a lot of general books in finance, such as How Big Banks Fail, Marrying Corporate Default Risk, and Dark Markets, and maybe next book on digital currency. As to today's topic, on May 25th, I remember in the fifth Frontier Dialogue hosted by Luohan Academy, Professor Duffy already gave a quite impressive and a little bit controversial, I would say, a discussion on CBDCs at the time. It has been 5 months over, and today is our honor to have Professor Duffy to share with us about his thought on the introduction of CBDC. Without further ado, Professor Duffy, the floor is yours.
Thank you so much, Ingju. It's terrific to be here. I'm glad you noticed that my remarks in May were somewhat controversial. I think they are somewhat against the grain of a lot of thinking on this problem, and I want to explain in more detail today. And first of all, let me thank everybody at the Luohan Academy for inviting me, and it's such a pleasure to be part of this academy and to learn so much from your meetings. So today I want to talk at a very high level, not about the details of what CBDC can do, how it's built, but rather how central banks and more generally governments are grappling with the decision about whether to have one or not. And in my view, some of the misunderstandings about the motives for doing this and also some of the misunderstandings about the disadvantages of doing CBDC. So without much delay, I'm going to jump right into some slides. I'd like to keep this conversational, so please interrupt whenever you like. And I hope to leave plenty of time at the end for a good, healthy, robust discussion of the policy issues. So if you're seeing my slides, you're seeing the prototypical Alice and Bob. They're always Alice and Bob in a discussion of digital payments. And Alice is at the bakery. She has to pay Bob $8. $8 is a lot for a loaf of bread, but here in Palo Alto, things are pretty expensive. And Alice has to figure out how to pay. And the whole discussion is surrounding how she's going to make the $8 payment. She could make it in paper money, but the vast majority of payments in most economies today are not made with paper money. They're made electronically. And in the United States, by far the most common method of payment is to use an electronic message to your bank and to tell the bank to move the $8 out of Alice's account through the payment rails, which can be very complicated. And eventually the $8 will show up in Bob's account at his bank. And usually Bob will get a message right away saying the money is coming, although the money doesn't get there for a day or two, or possibly 3. Business-to-business payments are made the same way. Often the message is still done in the US by a paper check, actually, for businesses, very common. But credit cards are very popular. Debit cards are somewhat popular. Direct bank transfers are a bit more popular in Europe. They're almost not used for general purpose payments in the US, but they are used somewhat. And as everybody in here knows, we're here to talk about other ways to do this that are coming into the economy, ways like using a fintech payment service like WeChat Pay or Alipay, or using stablecoin, or using a central bank digital currency. technically, I guess you could say that WeChat Pay and Alipay are also bank railed now because they have to be made through, or at least the money has to be stored at a bank. But I consider that a fintech entrant into the bank rail payment system, and that's important for reasons I'll discuss. So as I mentioned, the bank payment rails are reasonably complicated. I'm not going to try to give you a summary of how it all happens. There's for card payments, there's several cryptographic token steps that have to happen, and a lot of messages going back and forth, a lot of actors taking money out of the payments. Banks take about 80% of the credit card interchange fees. Credit card companies get about 20%. There's various other fees involved. Banks use usually some form of central bank or netting against central bank deposit accounts. And eventually the money gets from Alice, who might be, let's say, customer 1, down to Bob, which might be customer 7 of his bank, possibly by a route like this one. It's not working very well. It's been going for centuries, actually, since the time around 1607 in at the Bank of Venice, the idea that you can make a payment by debiting your own bank account and crediting the account of your payee's bank has been around for centuries, and it still accounts for the vast majority of payments globally. But the days of that may be changing. Well, let's see. There is a lot of disruption coming. Let me unpack this slide, which is based on data in McKinsey's latest global payments report. The stack is the various components of payment revenues going to financial services firms. The left stack is for North America. That's as fine as they break it down. They have components for various other regions like EMEA, which is a very broad region, and Africa and other areas. But let me just do North America and rest of world. You can see North America, the total payment stack is about $485 billion of revenues a year. That's very substantial. It's about 2.1% of GDP. And many people don't realize that consumers and businesses are paying about 2.1% of GDP to have their payments made. Now, that's not a deadweight cost. A lot of that is profit margin. And you can tell, for example, by looking at the bottom segment for North America. North America is very consumer heavy relative to the rest of the world in terms of payment revenues. And in the consumer sector, it's extremely heavy on the card or credit card component. And that's because interchange fees are very high in North America. They're over 2.2%. I'm going to come back to this, but it's a high profit margin industrial organization that's extremely hard to enter. The reason it's hard for firms to enter and compete down these very high profit margins is that we have a classic Rocher-Tirole two-sided market situation. Let me unpack that a little bit. Rocher and Tirole explained that a question. No? Somebody just...
而且你知道吗？你到时候靠那儿都可以墙，那个床不一定靠在那边的墙上，你那个书桌都可以收拾中间那块做你的那个。
Okay, we got that one.
Yeah.
Okay, so as Rocher and Tirole explained, let's talk about the consumers. They're getting a good deal here. The people, when you go into your coffee shop and you whip out your credit card and tap it, it seems great for you. It's just one tap. It's as easy as making any other kind of fintech payment, and doesn't look like it's costing you anything. And you might get reward miles for your airplane rides or bonus points or cash back. So you think it's great. The merchant, however, is suffering a big cost. So why doesn't the merchant use some other payment service and not have to pay such a big fee? Well, because when you go in and you want to pay for your coffee, you want to use your credit card, and the merchant doesn't want to lose your business, so they take whatever you have. There's a network effect as well. Since everybody is using these cards, everybody wants to use them. And so you get this network effect that's very hard to break into, two-sided markets with lots of network externalities. And as a result, you get oligopolies with extremely high profit markups. And the rest of the world, less so, because in some countries, like in Europe, interchange fees are regulated down. Now, that's not to say the rest of the payment stack is unimportant. Business-to-business payments are also very expensive. The commercial part in the US is less, but it's still, remember, the stack in the US is bigger than the stack for the rest of the world. It's 2.1% in the US, much less in the rest of the world. So the United States should be the first place at which regulation and possibly a central bank digital currency would come in order to encourage more competition and more innovation, faster, cheaper, more efficient payments. But it's not happening yet. And that's why we're here today to talk about this. So one possibility, as I mentioned, is to introduce a central bank digital currency. This is a schematic meant to simplify the problem, but as everybody knows, Alice is probably going to get a payment app and buy her digital currency through her payment service provider, PSPA. And once she has that app, she can tap the app at the coffee shop, and a message will go via her app to the central bank. The bank will remove $8 from her account and put it into Bob's account. It's real-time gross settlement, so Bob will get the money right away, and he'll get a message saying he just got the money from his payment service provider. And then, of course, he can pay his vendors and everybody else, if he wishes, by central bank digital currency. So what's not to like? It's cheap, it's fast, there's no credit risk of any kind, no counterparty risk. If it's well designed, the payment service providers can provide efficient apps, and you don't have to have the central bank doing that. The central banks are not like, unlike our host today, the central banks are not noted software developers. And I noticed that in China, which has a version of this, Alipay is one of the software components of the ECNY system, which runs pretty much like this. Although in China, there's multiple places at which the ledgers are kept and where the wallets are kept. And it's not clear in other countries how that's going to happen. Now, as almost everybody here knows, there's been a huge amount of activity in the central banking community in researching and developing central bank digital currencies. It seems like almost every day there's a new announcement. Today, just today alone, and it's a typical day, there was a news story about one of the governors of the Central Bank of Switzerland, the Swiss National Bank, saying that they could probably be ready by January to go live with a central bank digital currency in Switzerland. That's not to say they will, but it's pretty much developed. Also today, a paper from the Monetary Authority of Singapore came out with actually a very excellent discussion of costs and benefits, not, however, tipping their hand about whether they're going to do this. As everyone knows, Sweden, the European Central Bank, and many other central banks are in the course of developing CBDCs, and China is pretty much ready. About 10% of people in China have used a wallet to hold ECNY, although it's not clear to me yet how much people in China will actually prefer to use CBDC. That remains to be seen. Just going aside to China for the moment, I didn't put it in my slides because it's somewhat controversial, but the motives for ECNY in China are mixed. I think initially China wanted to do this to make sure that it didn't get too much invaded by undesired cryptocurrencies. And the Bank of Canada has set aside the same reason for developing a CBDC. The People's Bank of China is also concerned, I think, that the fintech payment services, Alipay and WeChat Pay, have such a large market share, over 90% in urban areas, that they have become too dominant. And you can interpret that two different ways. Wu Changchun, the chief spokesperson and head of the Digital Currency Institute of the People's Bank of China, has said, we want to have an operational backup. You don't want to be reliant on one or two fintech payment services. But another interpretation of not being too reliant is that the central bank and the government of China more generally would rather control this space. There's a lot of data, there's a lot of commerce. It's not common in China for the central government to prefer a situation in which private firms control this much data that affects the lives of everyone. That's my controversy for this morning. I want to move on, however, and talk about policy, generally speaking, around the world and not just in China. But I hope we'll get some engagement later on the situation in China. I'm working on a big report with 25 experts interpreting what China's doing with ECNY and what the United States should do with its own payment system. So let's go to the Bank of England. I think the Bank of England, while it's not yet developing a CBDC, has some of the most thoughtful and forward-thinking work on the problem. And I would add to that, by the way, the Monetary Authority of Singapore, whose report came out today. I do recommend it. But anyway, the Bank of England has given 7 simple reasons for wanting to have a CBDC: supporting resilient payments, avoiding the risks of new forms of private money creation. We're going to talk about stablecoins in a minute. Supporting competition, efficiency, and innovation in payments. As I mentioned a few minutes ago, one of the main reasons to do this is to create competition for bank payment services, which in my view have not been subjected to sufficient competition. And if nothing else works, nothing else meaning regulation or fintech payments, then CBDC is your last remaining option. And that's the way that I think about it. Just to let the cat out of the bag, I'm speaking pretty quickly today because I want to get all my key points in before the discussion gets too thick. Just to let the cat out of the bag, my view is that a country like the United States should immediately begin developing this technology, not delay. This is a multi-year development project. It's taken China 6 years to get ECNY up. The United States is a even more deliberative government apparatus and requires buy-in from many different constituents. And the technology is far from simple. Never mind what some may tell you, balancing the protection of privacy with the ability to detect illegal payments is a big lift, not to mention how to reach consumers efficiently. It's not simply the movement of electrons on a ledger. There's a lot involved in this in terms of policy and implementation. And the research work that's going on at the Federal Reserve Bank of Boston is just a very basic research. So the United States should begin developing immediately so that perhaps in 5 years, it will have the technology if it needs to use it. But it's not at all clear, and that's the point I want to make over and over again today. It's not at all clear that this is the best route to improving payments. It's the nuclear option, if you like. If you can't get regulation to force more competition into the banking system through entry by fintech firms or open banking, then this is your remaining option, and it should be made ready. In a smaller economy, not the United States, but a small open economy, there's a completely unrelated reason to get busy on this immediately. And that's the fact that you could be subjected to dollarization or yuanization, whether by a foreign CBDC or by a foreign stablecoin, more likely by a foreign stablecoin. And you want to get people using your own digital currency before someone else's digital currency invades your monetary sovereignty. That's one of the key reasons that's given in the Monetary Authority of Singapore report that came out today. Again, which I highly recommend. Going down the list, we've touched on the first 3. Meeting future payment needs, either a CBDC or a private sector fintech solution will be needed in the future digital economy for doing things like programmable money, smart contracts, and many other applications that involve tokenizing money. Improving the availability and usability of central bank money. What does that mean? Well, for me, it meant going along with number 6, that the last time I went to Stockholm for a conference, I brought my old paper money, several hundred kroner of banknotes, and I said, this is great, I'm going to use up this old paper money, and my hotel wouldn't accept it. They said, we don't take paper money anymore here in Sweden. Nobody uses paper money. So I had to come back home with my hundreds of kroner in notes, and the decline in cash affects the availability and usability of central bank money. And so another reason to do this is if you're a central bank and you really think that your citizens should have access to an official form of money, then this is your chance if you don't introduce a CBDC or ceding the space to the private sector. Now, I don't think of that as economics very much. I think the private sector can do a pretty good job if it's competing properly to provide private money. That's the way things used to be in most countries. It's not impossible as long as you regulate private money so that it's safe and interoperable. But if you really believe that consumers should have access to official money, then this is the time to begin working on that before paper money goes out of circulation. And then finally, which I won't have time to talk very much about today, cross-border payments. There's a different way to do cross-border payments with CBDCs that cut out enormous costs and delays. And it's a whole use case in and of itself. It doesn't necessarily require a general purpose retail CBDC to do the cross-border payment, but it might be convenient to have an interface between a domestic retail CBDC and a cross-border payment CBDC. And the M bridge that's being worked on at the Bank for International Settlement hubs around the world is a very good example of how that may develop. And the last report that came out 2 weeks ago from the Bank of Thailand on the hub that connects Thailand, Hong Kong, China, and the UAE is an excellent list of use cases with private sector market participants giving relatively detailed descriptions of how they envision using M-Bridge for cross-border payments in various applications. That's about as much as I'm going to say about cross-border unless we come back into that. What I want to talk about are some of the other costs and benefits that are not on the Bank of England's list. I was a bit surprised that the Bank of England did not put financial inclusion on its list. Now, one interpretation is that the United Kingdom already has very good financial inclusion, and that's not a motive for adding a CBDC. Another interpretation is that it's far from clear that a CBDC has a big impact on financial inclusion. It's one of the major reasons that's being put forward in many countries, and I think it has some potential for doing that, but none of the proponents of CBDC for financial inclusion have really explained why that will work or how it will work. There's a sort of vague indications or promises that if everybody can have access to a CBDC, then the fact that they don't have bank accounts will be less important. But no one has explained yet how it is that everyone gets a CBDC access or wallet. Is it that they're going to sign up for a CBDC with the Fed? Probably not. Are they going to go to a bank? Probably. If they're going to go to a bank for CBDC, why wouldn't they get a bank account at a instead of a CBDC account? Now, maybe they're more reluctant to give up their private information to a bank. I would say in the United States, most of the 5 million households that do not have bank accounts are more afraid of a government regulated information system than a bank regulated information system. So I don't think that's it. It could be that bank services are very expensive, and that's a good reason to regulate bank accounts so that they're very cheap. It's not necessarily a good reason to introduce a CBDC in and of itself. Now, some countries are making great progress on financial inclusion without necessarily invoking CBDC, and I would put India at the top of the list with Aadhaar and UPI. They've done an amazing job at increasing financial inclusion simply by requiring that all banks provide free bank accounts to everyone, and then making it very easy to move money using Aadhaar. And that's become extremely popular in the last 2 years. So is CBDC a method for increasing financial inclusion? Possibly, but I've yet to see it explained well why it will make a big difference. And so even though I'm a proponent of developing CBDC, so far, this is not the strongest argument for doing it unless and until someone explains how it's done. Now, let's go to some of the other fintech possibilities beyond CBDC. One of them is private stablecoins, and I'm sure everybody here knows how this works, but just let me remind you. Alice goes to her stablecoin issuer. It could be in the US Circle, which issues USDC, and says, here's $500 from my bank account. I want 500 of those stablecoins. They're each worth $1. The issuer gives Alice 500 tokens and takes her $500 and invests it in a trust which holds high quality liquid assets. Those high quality liquid assets, in principle, would be nice if they were Federal Reserve deposits in the United States. So then there would be really, really strong protections for Alice that the assets backing her coins are good. So far, the United States has not gone this way. There are no narrow banks issuing private stablecoins backed by Federal Reserve deposits. There are some stablecoin issuers that are backing their coins with other types of assets, which are not as good. The Fed is reluctant to provide these narrow banking accounts to fintech issuers of stablecoins, whether they're a new bank or anybody else. However, recently the Treasury Department issued a report. Last week, in fact, it was announced at Stanford University by Treasury Undersecretary Nellie Leon. This report explains that the approach in the United States that's recommended by the Treasury and by all of the agencies, all of the US regulators, is that these stablecoin issuers must be banks. Now, it doesn't say exactly what kinds of banks, and it doesn't say how the stablecoins must be backed and in what form, and whether the assets are segregated or whether they're insured or anything else. That announcement has been a big positive in the view of some, because it makes clear what you must do in order to issue a stablecoin and removes a lot of uncertainty for entrepreneurs. And by others, it's been heavily criticized, saying, what do you mean? This is just entrenching banks even further, because now only banks can issue these. So we don't know yet what's going to happen, whether this will require legislation or whether anything is coming, but private stablecoins are a fintech alternative for making payments. So far, they've only been used in the crypto space as a medium of exchange for cryptocurrencies, almost exclusively. But there's no reason in principle they couldn't be used in the broader economy for Alice to buy her loaf of bread at the bakery. And that might be, if we can't get banks to compete, that might be an opportunity to force them to compete harder if you had stablecoin competition. Yet another approach is a fast payment system. The key defining properties, this is a bank railed payment system. It's 24/7, 365 availability, as opposed to today where you can't move money in a bank railed system unless the banks are open, which is during the day. It gives you near real-time access to the funds by Bob the baker. He gets his money immediately without any credit risk, and it's real-time gross settlement. So there's settlement finality, everything is good. The United States has already experimented with this in the private sector with a system called RTP, or real-time payments, but not that surprising to me, since RTP is controlled by a consortium of banks. It hasn't really made much of a difference in terms of the efficiency of the US payment system. It's not very broad spread, hardly anybody knows about it. There are no easy apps on your phone by which you can swish your money around on RTP. And the profit margins in the payment space have kept pretty much where they were, high. The Fed, therefore, has decided it's going to introduce its own real-time payment system called FedNow, coming out in 2 years. The unfortunate thing is that so far, the Federal Reserve seems to be ceding the distribution and application space to the commercial banks, saying, here is our technology, FedNow, go ahead, banks, you may now deploy this technology as you see fit to your customers. Now, if I was Bank of America or Chase, there's no way that I'm going to tell my customers, we would really love you to use this FedNow payment and take away our profit margins on cards and other payment services. It's just not going to happen. And so I'm not expecting FedNow to make a big difference unless it's coupled with regulation that requires a significant amount of interoperability across the applications provided by the banks with FedNow, and that there are additional safeguards for competition. So I have a very strong opinion on that one too. We can come back to that. Here are some examples of fast payment systems that are already in place. Korea, Bank of Mexico have been doing this for decades. China does have a fast payment system, but it also, of course, has WeChat Pay and Alipay, which essentially does the same thing. Sweden has been out in front. The United Kingdom is getting going on this. Singapore is doing really well on fast payments. And the European has a target instant payment settlement system, which is called TIPS, which is coming into play. The United States, I already described the situation. Brazil is thinking of using its fast payment system as, which has been very successful. It's called forgotten the name of the Brazilian, PIX. The Brazilian fast payment system could be the basis for a CBDC, and Brazil is considering that. Because instead of giving fast payment accounts only to merchants or banks, you could give a fast payment account to everybody. That's a possibility. That's a cheap and easy way to get a CBDC, is just take your fast payment system like FedNow and just give everybody an account. Now, let me get to what I think of as the most interesting economics of all of this. But before that, let me pause because I'm just getting to the heart of the story. And I've been talking at high speed. I've not left a single airtime gap for anybody to interject, disagree, comment before I get to the really interesting part, which is what happens to banks when you do this. Okay, I don't see any hands up, so I'm going to get into the real heart of the matter. If you, Rodney.
Yeah, no, I thought if you'd like, it's always nice to get questions, I think, during.
Good, I like questions.
If I was to give one question, which maybe it would be better at the end, but if you think about, you've mentioned a couple of times the idea of CBDC as competition to banks, you know, and particularly with regard to bank payment services. Would the credible threat of a CBDC be enough? So what if the central bank was poised and ready to produce? Do we actually need to produce it, or is a credible threat enough?
I wrote exactly what you just said into my Senate testimony to the Senate Banking Committee this summer. I said, as long as the Fed is not developing a CBDC, the banks will not feel any particular need to move aggressively on improving the efficiency and cost of payments. But if the Fed begins a full-scale development project, which would be my wish, then the banks are going to say, gosh, we better get going here because they're going to take our space. They're going to drive down our profit margins, as I'll explain in a minute, and we'll lose touch with our customers. So let's get moving. And I think you're right. The threat of it would be enough to make a big difference. The other way to do it is simply regulate competition. But I think the way that the United States is wired in terms of regulation, it's going to be harder to do to regulate it, but simply having a CBDC development project may do the trick. The other threat point is to introduce stablecoins, saying, if you don't do it, we'll let the stablecoins in. That's a bit trickier because it's a harder thing to control. Any other questions before I move to the impact on bank funding costs, and what about credit provision? Okay, I'm going to take a new whack at this. I've tried maybe 5 different ways to explain why I think some central bankers have the wrong idea about the impact on credit provision. And I'm going to make this real simple. I'm going to oversimplify, in fact. I don't believe 100% of what I'm saying. I believe it 95%, and I'll explain the other 5% in a minute. Okay, so here's the story that you get told both by the Bank Policy Institute, not so surprisingly, and by some central bankers, like Vice Chair Quarles, who's a strong critic of CBDC, and like some papers at the BIS, which have suggested that when you introduce a CBDC, credit provision may be adversely impacted. Okay, so here's the story. You have this bank that's intermediating. It has two sources of funds. Again, I'm oversimplifying. It's getting general purpose deposits, and it's widely conceded, and we have a few experts in the room here today, that deposit funding is way below market. If you look at the numbers on the bottom of this slide, I'm just giving you an example from the last time that US interest rates were not near zero, April 2019. The wholesale rate was 240 basis points. So wholesale funding was what it was. It's the market rate, 240 basis points. But banks could get a lot of their funding from much cheaper sources, from their depositors. And the weighted average deposit rates, as you can see on the bottom of this page in basis points, were 10 for savings, 6 basis points for interest checking, 19 basis points for money market. That's small size CDs, certificates of deposits, and 29 basis points for jumbo money markets. That's large CDs over $100,000. Those are the weighted average across the entire United States banking system using FDIC data. They're posted on their website. You can go find these data. Now, when I talk to some people, they say, no, banks are very competitive on the deposit side. There's thousands of banks, surely they're competing with each other. But if you look at the numbers, and if you have common sense, you know they're not competing, because there are high switching costs for consumers to move their money from one bank to another. I don't know if you've ever tried it, but I've tried it. It's not easy to move your money from a deposit account in one bank to a deposit account in another bank. So the idea that consumers are always switching around their deposits to get the highest interest rate is simply false. And consumers are sleepy as well. They're not paying attention. When I went to my bank, the last time the Fed did increase rates, I said, the Fed increased rates 25 basis points. And facetiously, because I knew that what they were going to say, I said, how about increasing my deposit account by 25 basis points? And the manager at the bank looked at me and he said, well, we talked about it and we decided we're not going to do that. What does that mean? It means banks basically have the market power. They can decide whether they're going to offer that higher rates or not. They do eventually compete a little bit, but not very much. So banks are getting really low cost funding from depositors. And whatever additional funding they need, they get out of wholesale markets. And so I put up some fake numbers that are kind of representative of numbers at a particular point in the interest rate cycle. And so I'm assuming, for example, that deposits are funding at 50 basis points and wholesale funding is 100 basis points higher at 1.5%. So this is a sweet deal for banks. They're basically getting they have a profitable deposit franchise and low competition for those deposits. Now, if a CBDC came along, or a stablecoin, or a neobank, a narrow fintech payment bank, the banks would say, consumers are starting to move their money to these faster, more efficient, cheaper payment services, or businesses are. So we'll have to raise our deposit rates, or alternatively, they'll leave their deposit rates low and let some of the deposits migrate into CBDC or other payment media. And I agree that that's going to happen. Everybody agrees that that will happen to some extent. There's hardly a paper that says, including research papers. There's a great paper, for example, by Chiu, C-H-I-U, and Davildahusian. Do you know how to say his name, Rodney, at the Bank of Canada? No, okay, it doesn't matter. I don't know how to say his name properly, but they have a paper. All the research papers agree that if you have a CBDC or there's fintech competition for banks, that banks will either lose deposits or have to pay up higher rates for deposits, and their average funding costs will go up. So that's totally on agreement. What's on disagreement is on the right-hand side. What's the impact on credit provision? Now, let me tell you, in my view, this is the main policy concern at the Federal Reserve. All of the speeches that you've read had this explicit or implicit, and my conversations with the insiders tell me that the biggest concern is that if you make banks compete and pay higher deposit interest rates or go to more wholesale funding, credit provision will suffer, because if your funding costs go up, you have to pass that on to your borrowers. Now, I simply don't see why that's necessarily so. I'm not saying empirically it might not happen, but the arguments that are made that borrowing costs, corporate or other borrowing costs, will go up are simply not well-founded. And the logic is really simple if you look at it. In this diagram, the bank is providing loans to borrowers at, let's say, 1.6%. And these arguments that credit provision will suffer would therefore have you believe that were it not for the cheap funding, those borrowers, some of them would not be getting credit. Some of them would not get loans. Now, who is it of those borrowers that are getting loans that are not that would not get loans? That the banks don't have to provide loss loans. They're not required to lend to borrowers and lose money. They can simply take the funding that they're getting, whatever the funding, and invest it in the bond market. There's no need for them to take a loss on a corporate loan. It's not as though Rodney over at the Bank of Santa Barbara is going to say, you know what, I'm getting such cheap funding on the deposit side, I should really take a loss on my corporate lending to be nice to those corporate borrowers, and I'm going to take losses because I can cover it with my profits on my deposit franchise. Rodney's not going to say that. That's crazy. He's going to say, I'm only making loans that are profitable compared to the alternative, which is to go into the securities market and lend, for example, and buy bonds. So why would it be that Rodney would stop lending to borrowers that he's already found to be profitable relative to bonds? All that's going to happen is that Rodney's profit margin is going to go down. If his deposit funding costs go up, his profit margins are going to go down. Banks are going to have lower return on equity, and it's going to be bad news for bank shareholders. But I have yet to see the argument for why corporate borrowing will suffer. Doesn't make sense. There's no economic argument that makes sense. There's also a recent research paper by Wenxin Du and collaborators that showed that in money market reform, when banks lost $1 trillion of low-cost funding that they were getting from the tri-party repo market, corporate borrowing, $1 trillion of low-cost funding went away. Corporate borrowers did not lower their credit provision. Banks did not lower their corporate lending, didn't suffer at all, not significantly. Okay, so this main argument against CBDC strikes me as totally unfounded. I have very strong views on this. Now, I told you that's 95% right. Let me give you the 5% that I think where there's an actual argument that corporate borrowing may suffer. And that's small community banks in outlying rural areas. And this could happen in any country. Suppose, for example, that Rodney's bank is in the middle of Nebraska, which, as for those of you that don't know, is a very rural state, and the middle of it must be in the middle of almost nowhere. I don't even know the name of the town in the middle of Nebraska. And Rodney is getting these cheap deposit funding, and he has to cover his overhead. He's a small bank. Overhead is quite a lot for a bank. Has to run, bricks and mortar and paying the manager and all that stuff. So somewhere or other, he has to cover his overhead. And all of a sudden along comes the CBDC or stablecoins, and everybody in Nebraska says, oh, I'm not shopping with Rodney anymore for my deposits. I can make my deposits into CBDC. Rodney's funding costs go up. Rodney can no longer cover his overhead because that's his real profit margins are coming on that side. And if you can't cover your overhead, you go out of business. The corporate borrowers in the little town in the middle of Nebraska are then going to say, whoa, this is bad. My bank's gone away. I have to go to the big city to get funding. They don't even know me there. And so my cost of borrowing is going to go up. That's possible. So, and it's also politically quite potent because community banks, there's thousands of them. They're dispersed all over the country, and nobody in Washington, D.C. will ever want to mess around with credit provision by community banks in small outlying regions. Now, it's a very small fraction of total credit provision, and maybe the borrowers will get along okay by borrowing from bigger banks. At this point, I would not want to be a shareholder in a small rural bank in the United States. If it's not going to be CBDC, it's going to be some other fintech or information technology change that's going to make it very hard. There's been some legislation in the US to try to cover their losses. One of them is called the Durbin Amendment, but we won't have a time to talk about that today. Okay, that was my big issue. Now I'm going to move on to cleanup. Yao Zhang, what do you have?
Yeah, sure. And yeah, I think this is super interesting, Daryl, and I'm fully with you on the lending side. If it could go back to the funding side, I wonder maybe one alternative would be banks and they simply rely more on, for example, equity funding or maybe issuing long-term bonds. And that might be a good thing, right? Because we know that a huge cost for deposit funding is deposit insurance, and that's actually a huge social cost. So I'm not sure how do you think about that, potentially switch for banks in terms of their funding structures.
Yeah, well, the pecking order for funding is always to get debt funding over equity funding. So you're going to go to debt markets first. And you're right that if you lose deposit funding or it becomes very expensive, then you'll go into wholesale markets, some of it short-term, and by regulation, some of it must be long-term. So your cost of funds will go up. It'll still be cheaper than equity funding. And you're right, some of that will be long-term bonds. And banks will have stable funding, but more expensive funding, and they won't like it. It's not good news for bank shareholders. It's bad news. So I feel sorry for them, but not so sorry that I would change my policy recommendation to go ahead and give the banks lots of competition on the deposit side. Okay, now let's go ahead and talk about another possible criticism of CBDC, which is Alice is going to get her CBDC and maybe her payment app as well from her payment service provider, which could be a bank. And Bob is going to get his from his payment service provider. So far, there's nothing guaranteeing how this is going to go in terms of, well, maybe Bank of America likes to have a payment app that features all Bank of America stuff and has software designed by Bank of America that is supposed to meet certain interoperability standards, but nothing guarantees that when Alice walks into Bob's shop and Bob does his banking at Chase, that their payment service apps are going to actually interoperate. So if you have what's called a hybrid CBDC, which is the most likely approach in most countries, including China, you really need to make sure that these payment apps are either identical or the standards for interoperability are extremely high. And again, if banks are the payment service providers, they don't have the greatest incentives to make sure that their payment apps all interoperate. They like to have walled gardens. They want Rodney to shop at the same bank at which he does his other financial services. They don't want him moving over to the other banks. China is a similar situation. There's also been some attempts by China's regulators to get firms like Ant Group not to combine their apps into a super app. If I was, I'm not giving a policy recommendation here, but if I was a consumer in China, I would love to use the Ant Group financial services app, because then I can do everything. I can do my payments, I can do my stock investing, I can do my insurance, I can do all of my financial services on one app. It all has the same look and feel. Very few thumb or finger manipulations are necessary to do all my things on my iPhone. And if I was Ant Group, I would want to keep it that way. I wouldn't want to make it terribly easy for my payment app to interoperate with some other firm's investment app. That would not be in my best interest as a shareholder of Ant Group. And for that reason, competition authorities around the world try to make sure that firms like Microsoft and Google and other firms in the tech space don't make it difficult for their customers to go outside of their app environment to use apps from other providers. And the same thing could happen in the CBDC space unless there's a strong safeguard against that, because the incentives are running against, not in favor of interoperability. I'm getting towards the end. I'm going to skip cross-border payments. As I told you, if Alice is in Thailand and Bob is in China, then what you really want is to avoid the very complicated, expensive cross-border correspondent banking and have Alice have a simple way to send money to Bob, maybe through the MCBDC bridge, which is a place where CBDCs for Thailand and China interact. This is a corridor, a payment corridor that bypasses a lot of correspondent banking. Now, exactly how this is going to work is not clear yet. But again, I recommend the recent paper from the Bank of Thailand that explains progress. Let me finish. This is my last slide before we enter a discussion. Let me finish with the main policy options. So first, use regulations and fast payment infrastructure to promote a more open and competitive bank rail payment system. I think you do this, countries should be doing this regardless of whether they're going to introduce a CBDC. This is kind of an obvious policy recommendation. Another thing you could do is to allow or encourage compliant stablecoins subject to interoperability standards. And the Treasury report that came out the beginning of last week basically says that. Although it doesn't, different people will have different views on whether the recommendations in that report are the way to go. I think most people would suggest allowing or encouraging private stablecoins, as long as they're compliant. A third option is to let fintech neobanks enter the bank rail payment system. Now, some of those neobanks could be stablecoin issuers. Some of them could be simply competing with banks to make payment services on the bank rails, not using necessarily stablecoins. My view is that the Fed should move along. The Fed is currently considering whether fintech neobanks should get accounts at the Fed. If they don't get accounts at the Fed, then they can't really compete because it's too difficult to set up a whole new network of payments if you're not plugged into the bank payment rails. As I mentioned, I think the nuclear option, the last one, but the one that should begin development immediately, is to develop a general purpose central bank digital currency. To have that technology, let's say it takes 5 years to do it, you wouldn't want to wait 5 or 6 years from now and then say, oh my gosh, everybody else in the world is now using this. We're losing competition globally. The US dollar maybe is starting to lose its edge in international markets, and our consumers are getting a bad deal. Let's start doing this. That happens 6 years from now, and then it's another 5 years until it's ready. That's more than a decade. That may happen. Right now, the United States is not really leaning hard into a CBDC. So I recommend the safeguard, which is what Canada is doing, what the ECB is doing, which is develop it now and decide later, once you've got it working, whether to deploy it. I think that's the wise choice. You don't even yet understand what are the costs and benefits and whether the technology is able to protect privacy and allow monitoring of illegal payments effectively, let alone other operational resilience issues like cybersecurity. So you need to get going on the technology. And then finally, I think it's very likely the world is going towards cross-border payment corridors that bypass correspondent banking. And so having special purpose CBDCs for settlement systems and cross-border payments in development seems like a pretty good idea too. So that's the end of my remarks, Idrin. And so I leave it to you to what we should do next. Let me take down my slides.
Yeah, let's go open to question. I think you can also leave the slides there if
leave them on.
Yeah.
Okay.
Yeah, maybe I can ask one. I have a question regarding to the intratemporality. If you can go back to that slides about the previous one.
The previous one. This one.
Yes. For me, I think it's more like a technological issue because you already said first you already praised what Group has done. Actually, I'm doing all the business in the same app, even buy insurance for my cats there, and it's quite convenient. And also, I actually have CBDC inside the app. I think for China's case, they already maintain this standard for every app, including the app from some banks, and still is in a experiment stage, but I think it's more like a technological. If the central bank consider this as an infrastructure, and if it's possible in terms of technology, what's the economic downside of this CBDC? I think they have an argument, although I'm not completely agree, saying that so those big fintech firms, say Group, already have a very large competitive advantage due to its more efficient, convenient services, but they don't want to this competitive advantage turn into a more like a market power or even a monopoly power. So by ensure that every app has the same standard, they want to kind of promote or encourage bank to increase their service. So yeah, that's my question regarding.
Okay, so that's a great question, and I agree with you that this can be done technologically by requiring standards, so that even if you're using, one company's super app, that the CBDC part of it is completely easy to interoperate with some other super apps CBDC, like let's say WeChat and Alipay. So it works in China, but remember the situation in China is a little bit different. The apps are being designed with a top-down approach. They're being provided to consumers through banks, which are largely state-owned. Everybody in China is pulling in the same direction because the state is pushing them to pull in the same direction. The United States is a different environment. It's very difficult to get the banks to line up and do the government's work for it. And so over time, I'd be interested in the views of those present. It wouldn't be surprising to me to find out that when I open my Bank of America app, that the CBDC button requires 1 or 2 extra taps if I want to do something outside of Bank of America than it takes if I want to do something inside Bank of America. That would be the way that America works, frankly. It's all based on profit, and everybody gets to do their own thing until somebody comes along and says, no, you're putting in extra finger taps or steps to go through or approvals to move outside your bank a CBDC payment relative to moving inside the bank. We don't let you do that. In America, that can happen, but it takes a while to get around to it. In Europe, the competition authorities are very rigorous. What's antitrust in Europe is a much lower threshold than in America. In America, you have to basically show that there's effectively different banks are working together to reduce competition, or that you're exploiting your market power in a very, very aggressive way. And then these things, and the government doesn't have the final say like in China. It goes into the courts, and then the lawyers and experts from both sides, maybe Rodney will be the consultant expert testifier for the government, and I'll be the expert testifier for Bank of America, and we'll pull out all of our research, and we'll argue and argue and argue, and then the court will sort of split down the middle, and the interoperability will be a bit better than it otherwise would be. You know, America is a different kind of place. So I wouldn't guarantee that if you have a hybrid system in the US, that interoperability is going to happen unless the government really leans hard from the beginning on the design for interoperability. Sorry, that's such a long answer. Rodney, I think you're next.
Thank you.
Yeah, sure, Joel. Thanks. I'd like to come back to your point about whether or not an interest-bearing CBDC would reduce bank lending, because I really do think that's a really important point that I think people are somewhat divided on. And I guess I just really sort of have a comment, which is that you mentioned thinking about this from the perspective of the supply side, from the bank's point of view of offering loans, and how, you know, the fact that the CBDC interest may increase their cost. But we can also, this is just, I guess, a comment, that we can also think about this from the demand side as well. And so, you know, one of the things that CBDC, an interest-bearing CBDC would do, it would impact deposit rates, as you say, but that's going to impact where depositors go. And if we think about heterogeneous banks, because you mentioned the idea of community banks, then as you know, my paper with Hao Zhang, we show that the large banks increase their rates more in response to the increase in the CBDC rate. So they attract more depositors, but they have better ability to offer loans. And so that actually causes loans to increase. So just as you say, the overall effect is very ambiguous. But I just wanted to bring in this idea that the effects are coming not only from the supply side, but also from the demand side.
Yeah, that's a really good point in your paper with Hao Zhang, which, by the way, for those of you present, is being presented this morning or this afternoon in Europe. Is that right, Rodney?
Yeah, sometime like right around now.
Sorry, you're missing it.
Yeah. And Rod will present that paper maybe later in Lohan webinar. He already sent us the request. Yeah.
So one other point that I would make, Rodney, is that my prediction is that if you have a really good CBDC, the better it is, the less it needs to pay any interest for the effect to happen. Even if it pays zero interest, the increased mobility of money, the ability to swish your money programmably wherever you want it to go easily, is going to make banks have to pay more for deposits, because switching costs will go down and everybody will start to say, oh, I love my CBDC. Everybody's using it. I don't need to have all this money in my deposit account. I'm going to keep a stash of it in my CBDC account, even if it's paying zero interest. And moreover, if my bank starts to pay low interest when the Fed raises its rates, I have a programmable function on my app that just moves the money into a money market fund or to a bank that pays a higher interest rate using my super app. So I think that in China, Ant Group had what's called Yuebao for basically swishing your money into interest-bearing accounts. And I think, do you still have that at Ant Group?
Yes.
Yeah, I think it's the world's largest money market fund. So I think even if you have zero interest CBDC, if it's a really good one, you're going to get this same effect. And I agree with you that large banks, due to efficiency and sort of general equilibrium concerns, may actually increase credit provision.
Yeah, no, I completely agree. I mean, it's the whole menu of design characteristics of CBDC that's going to determine their adoption and their impact on deposit markets and lending markets. Absolutely.
There are several hands up. Maybe Luigi.
So, Daryl, how are you? First of all, I love your talk, and I agree with most of it. Let me raise two issues just for the sake of debate. The first one is you said that the funding should not impact, because basically it's the margin and not the average. However, if I am a small bank in Nebraska, when I lend to a builder in Nebraska, chances are that its money is redeposited in my Nebraska bank and at a zero deposit rate. So in lending, I should factor in the fact that I generate my own funding at a zero rate, and that doesn't happen when there is the CBDC. So that might impact the lending. Second point that I know you know, but I'm surprised you didn't mention, is if you introduce a CBDC in a world where there are also banks, there are likely bank runs. So how do you prevent this from happening?
Okay, so let's do the first one first. So there is a synergy between deposit taking and lending, and it's often emphasized by bankers, and Monica Piazzesi and Martin Schneider have a good paper showing that it's very effective for banks to be able to provide credit lines, and so that when a corporate customer draws on credit, they just put it into that bank and the same deposits. And that gives the bank an advantage. That's synergistic advantage. And the criticism that I have heard about CBDC is that, well, you don't want a CBDC to take away the synergy, because when people pull their money out of banks, banks are not able to exploit the synergy. You have a deadweight loss associated with this loss of synergy. My argument is the opposite, which is if banks, and banks do have this synergy, it gives them a competitive advantage against entrants that allows them to continue to provide loans at lower interest rates than would be provided by other providers of loans. So the entry of a CBDC does not take away that advantage. It makes it even easier for the banks to compete against entrants. And if the entrants are able to nevertheless take away funding from the banks, despite the bank synergy, that means either the banks are exploiting their profit margin, or the synergy is not strong enough to overcome the efficiency advantages of competition. So while I grant the premise of what you're saying, Luigi, I don't think it amounts to a reason to avoid introducing a CBDC. On the second point, there has been a lot of discussion about the fact that if a bank gets into trouble, then people could swish money out of their bank account very quickly using a CBDC app, take it into a safe place. I'm of mixed views about whether that's actually important. Let's just review what happened in the financial crisis of 2008. Some banks did experience runs, not so much, but some. And where did the money go? It went into other banks. It didn't go into treasury bills or something else. Maybe that was because it was convenient. For the banks that did lose deposits, there are two types: the banks that were insolvent and the banks that were solvent but not liquid. And the Fed is able to help the latter category with lending of last resort. If CBDC leads to a bank run, then the Fed will save the solvent banks and let the insolvent banks go. And that's a service that's provided by bank runs. Bank runs are not necessarily all negative. Some aspects of bank runs are positive. It's also the case that the greater the success of the CBDC in reducing bank deposits, the less deposits are left to run, the more the banks are reliant on long-term wholesale funding, which is more stable because it involves less maturity transformation. You might ask, well, why wouldn't banks do short-term wholesale funding and be even more subject to runs? Because wholesale lenders are even more apt to run than depositors. Well, the reason that won't happen is that the Fed has changed the regulations requiring that banks do not have very much short-term funding relative to long-term funding. They allow banks to have a lot of deposit funding because it's quite sticky. But as the banks become more reliant on wholesale funding, it has to be termed out to longer and longer maturities, which means they're less and less subject to a run. The other mitigant of the whole issue of bank runs is, okay, we have a CBDC, but it's only for retail purposes. Nobody can store more than, let's say, $100,000 in their CBDC app, a wallet. And as has been shown by Josh Younger at JP Morgan, if you only allow retail CBDC of a capped amount, there's not enough deposits of that type to really cause much damage in a run. So that's all the arguments I can find, but I do agree that it'll be easier to have a bank run, and that one needs to manage that. Luigi, you usually come back quick. I'm worried now you're not coming back at me.
Sorry, I didn't know that I can continue going back and forth. No, I think that on the second point, I agree. I think that there is a risk of instability, though. I would like to know your opinion on the Chicago plan by Henry Simons to have like more narrow bank, because once you go down that path, I think that that's the natural outcome. On the synergy, I think that if I understood correctly, you're mixing two things, so I wasn't clear. Because there is a informational advantage, which I think actually can go the other way around these days, because if I have a CBDC, a central bank running all the transactions, they have all the information and they can give the information to whoever I want that information to be transferred. And so there's more competition in lending. And that's actually, I see that as a net benefit of a central bank digital currency versus a system of open banking where you force people to transfer the information. But when you force people, they use all the tricks that you described not to make it happen. So I think in that sense is a net positive. What I was saying is, and I will look at this paper by Monica Piazzesi, but what I was saying is that there is a natural lower cost because you internalize the fact that some of the deposits are going back. So in that sense, it is cheaper for this bank to lend. It is more efficient because you internalize this cost. So by internalizing an externality, you are making lending cheaper, which is going to have more lending, especially in small communities, and so an argument against the CBDC.
Yeah, just quickly repeat what I said, which is I agree with the advantage, and which means that the banks should have a head start on competitors, and they won't need to be protected from a CBDC because anybody that's providing a CBDC instead of a bank deposit is going to have to say, well, we can't offer you these synergies, so you probably don't want to use our CBDC. You probably want to stay with your bank. But if you do want to come with us and use the CBDC, it must be because you're not getting enough of the synergies. That is, the market should work, and it shouldn't be that you need to protect the bank in order to maintain the synergy. The synergy is already a source, as you say, of internalized protection. But anyway, I think we can pick that up another time if we're not converging on it.
So may I ask a question?
I'm not sure who's speaking, but anybody is free to ask, I'm sure.
Yes, so yeah, because Zoom is kind of unstable on my iPad. This is Sylvia Xiang from Peking University. In fact, I'm also researching on CBDC in the past like 2 or 3 years. I've been focused on this. So I think it's very interesting about regarding the question on the impact of issuing a CBDC on the bank funding cost. So I on one hand, I agree with you that it may have some, for example, some substitution effect on bank deposit, right? Once everyone is allowed to have, for example, an independent directly CBDC account. However, on the other hand side, I think that it may also depend on the designs of the CBDC. For example, you also mentioned China's DCEP, right? Because it has been running this pilot project very intensively in the past 2 years. And also, it also reveals the main design. For example, the main feature of China's DCEP is that it will be operated through a 2-tier system, right? So the first tier is central bank and second tier the commercial bank. I think that the main purpose of this design is kind of to avoid the possible financial disintermediation from issuing CBDC. Yeah. So in fact, I have a paper with my co-author Mei Zhong from University of Melbourne. We just finished this year. It's sort of using the main features of China's DCEP to build a model to study the impact on commercial bank. And our results show that it really depends on the designs. So for example, based on the feature of China's DCP, we think that it's more possible that CBDC and bank deposit can be complements instead of, not always, substitutes. So then based on that spirit, we get the results show that it may not necessarily, cause any negative impact on, on commercial banks, and it may have positive impact. Of course, it may depend on some policy parameter, but yeah, in general, we can sort of get that type of results. Yeah, so that's that's the part one. That's why for this part I'm curious to ask you that what do you think? Yeah, for this part. Yeah.
Well, I agree with you that with China's hybrid approach, and likely with the hybrid approach that would be adopted in the United States, that banks can combine their services in CBDCs with other services like payments, like lending and borrowing. You can lend and borrow CBDCs too, because after all, it's just another form of money. This is an option for banks to make more money. You can also provide one-stop shopping at your bank. Now, one must be careful. I agree that this may be good for banks in terms of the synergies related, in fact, to the synergies that Luigi was just asking about. But then one must be careful, because the more synergistic it is, the more you want to build what is sometimes called a walled garden around it, saying, if you go to ICBC, we provide all of these services, and you don't need to go anywhere else for your financial services. If you do that, then you raise the walls for movement and free competition across the whole financial system. And that may give the bank the ability to extract rents, which is exactly what the CBDC, well, not exactly, but one of the reasons that the CBDC would be brought in the first place is to force banks to compete against each other and to lower their walls. So I agree, and it is a social benefit that you described, Sylvia, but it's also raises the potential for creating market power that could become inefficient, in my view.
Yeah, I think that for example, to bring more competition to the commercial banks part, I definitely agree. I think that even in our models, I think that implicitly, so the condition that people are willing to, for example, to convert a CBDC into a bank deposit is because commercial bank have to offer a higher deposit rate. Yeah, so for that part, I think that we are at the same page. Yeah.
Good.
Yeah. Thanks.
Boris, I saw you raise hand along quite a while.
Yes, I mean, my question related to what Luigi raised, which is about the informational synergy between deposit taking and lending. And I guess I just wanted to hear Darrell's view on what would be the optimal access to information generated by the CBDC. Because there is some privacy concern, but in the same time, you also want to foster lending, and that may be a very powerful leverage to foster lending. And so I just wanted to hear his thoughts on that.
Yeah, so I haven't thought a lot about that, Boris, but the consumer should own the data and be able to have the ability to sell the data. But I'm not sure what that implies in terms of what industrial organization, what's the equilibrium degree to which there's a market for that information. The default should be that the central bank does not have the ability to share the information. Everybody wants to know that their data are kept private. So it's kind of like the tension in Europe between PSD2 and GDPR that, on the one hand, you want a market for information so that the consumer can take advantage of it and vendors can provide competition based on data access. And on the other hand, you want to protect privacy. And these two types of incentives sometimes run against each other. I don't know in the case of CBDC, but I do know that in America, I'm not Canadian myself, but in America, a very large fraction of the population is extremely suspicious of large centralized databases of private information. And just today, Robinhood, lost another 6 million identifications out of its account. But if the government had, let's say, 300 million CBDC accounts with everyone's private details plus all their payment information, Americans would generally not want to have that happen unless there were extremely, extremely tough safeguards. It wouldn't be the case like with Google, when you sign on and they ask, do you approve? And then there's a 12-page fine print set of screens that you scroll through quickly because you don't want to read it all and say, I accept, and giving up all of your information. I don't think that would be a sufficient safeguard for a CBDC, even if you did hit the I accept button. I don't think you want to play around. So the threshold for giving up information should be, in my view, for a centralized database for CBDC, extremely high. I don't know, but I'm not an expert on this. I'd be interested in your view. Do you have a view on it?
I mean, it feels a bit of a missed opportunity if we cannot share such valuable information that would allow for an efficient allocation of capital. I guess I'm a bit more on that side to start with, but I agree with you that the worst thing for many people is a large data set and the Fed interacted together. I mean, it's like people's nightmare in terms of suspicion. So the political aspect here is going to be first order, absolutely.
Yeah, I think you have your hand up.
Yeah, sure. Thanks, Dara. This is super interesting. I think one thing you didn't talk too much about that I want to build up on is the international aspects of that, because we all know that there is some debate about how, how should we think about foreigners holding CBDC, like whether we would allow Chinese people to hold CBDC issued by the US Fed or the other way around. And especially, I think there's some debate about the role of US dollars, right, as the reserve currency, and it's heavily used in international trade. So I would love to hear your thoughts about, these dynamics going forward.
Yeah, I've been speaking to US policymakers about this issue. It's a really interesting one. So first, I don't think that large central banks like the People's Bank of China or the Federal Reserve or the ECB are going to give foreigners accounts for CBDC except for special purpose cross-border payment applications. So the idea that US dollar CBDC or ECNY would circulate in foreign countries for general purpose payments is not going to happen very easily. The PBOC has already said we're not going to do that. Mu Changchun has made it very clear. Zhou Xiaochuan has said the same thing, that they're not into yuanization of other countries. And then you might say, well, maybe they will change their mind once it becomes convenient, and everybody wants internationalization of the renminbi, so why not? But there's a lot of problems there. And I think, first of all, you have to be responsible for the legality of payments wherever your payments are being made. And that's hard to enforce when you have foreign citizens that are holding payment apps. And secondly, you have to be concerned about all kinds of issues related to privacy. So my guess is that People's Bank of China will stick to its word, that the Fed, if it introduces a digital dollar, will not allow anything other than special purpose financial services firms abroad to have CBDC accounts. There could be one or two rogue countries that will say, well, let everybody use our one. We have a nice CBDC, and that will help us with seniorage. That could happen, but I don't think responsible central banks will do it. Now, that raises a really interesting question. What about stablecoins? So in Shanghai Free Trade Zone, there's a company issuing soon what's called CNHC, which is a CNH denominated stablecoin. In other words, renminbi stablecoins, specifically for cross-border payments internationally by business to business. So what does that mean? It means that there could be digital currency circulating offshore outside of China internationally in renminbi in the form of stablecoins. And that would serve many purposes in terms of internationalization of the renminbi and giving China more influence relative to the US dollar. And then the United States government will have a difficult decision to make. The United States can say, well, we don't want US dollar stablecoins polluting the waters of other monetary systems. We will restrict any US dollar stablecoin issuer from doing that. It may be hard to do. Tether is already an international US dollar stablecoin. It's not domestically available, or at least not supposed to be. And maybe USDC would be a great competitor for CNHC in a proxy competition for commercial advantage internationally to shore up the ability of the US dollar to compete against China in regions where CNHC is circulating or some other stablecoin. So you could end up with a situation where CBDCs only circulate domestically, but stablecoins are used internationally and become a kind of a different way to make international payments and to increase the dominance of your currency. That is a really interesting question, a policy issue and an interesting economics issue. There is a lot of money to be made. If you just look at CNHC, for example, China deposit interest rates are, I think they're around 3.5% now, something like that. 3.5%, let's suppose it gets as big as 500 billion renminbi, multiply that by 3.5%. That's a lot of seigniorage at very low cost. And I expect it's going to be a compliant stablecoin. My private sources tell me that the People's Bank of China might be okay with that stablecoin. That would be great for China and for CNHC issuers. They'd make a lot of money. I don't know how the United States government would feel about that. Probably not all that happy about it. So it's a really good question that you're asking.
Yeah, we have a related question from chat box. I'd like to read it out, but from a slightly different view. What's your view on MCBDC? I think it refers to multiple CBDC and stable coins and public chain-based cryptocurrency like Bitcoin and Ethereum on the long-term value proposition and viability of SWIFT. So,
wow, that is a lot. Okay, so SWIFT is trying to update its technology. I think it'll be around for a long time, but the CBDC bridges that are being built, there are several under construction, have the promise of being quite competitive with correspondent banking. It's not clear whether they'll use SWIFT for messaging or they'll use their own special purpose messaging. My guess is that China would prefer to use special purpose messaging or CIPS, which is the China Interbank Payment System, which is an alternative to SWIFT. The reason that China doesn't really like SWIFT that much is that it enables countries like the United States to impose sanctions on firms in China, and China's legislation against foreign sanctions is extremely aggressive and suggests to me that China has an extremely strong preference to avoid the ability of other countries to impose sanctions. So I think policy suggests avoiding SWIFT and from the viewpoint of China's participation in cross-border payments. But SWIFT is currently very strong. MCBDC is, in my view, a very promising potential technology. I mean, you have to think of cross-border payments as the worst of the worst in terms of payment inefficiency, and MCBDC bridges have some promise to cut a lot of the costs and time delays. So I'm quite positive on that. With respect to Bitcoin, no idea. It's a speculative investment. It has a small amount of payment services, much of which are legitimate and proper, and some of which are illegitimate and criminal. It's difficult to see. I know China has banned the use of Bitcoin. I think other countries may lean very hard against using Bitcoin for making payments. But right now it's at an all-time high in terms of value. So as a speculative investment, for those that bought it when it was cheap, it's been wonderful. I wouldn't buy it myself, but that's just me.
Okay, maybe due to the time, our last question to James Xu.
Okay, thank you very much. This is James from the SUSS from Singapore. So thank you, Prof. Dara. And actually, I just want to, listen to your, your speech about the CBDC. So I just want, I'm thinking about from a gaming model. So actually, there are a lot of things which is even without the CBDC was introduced in the market. Actually, this kind of gaming is still existing, right? So I am wondering, so what's the change from the introducing of the CBDC into the gaming between the central bank and the commercial bank, and also the commercial bank to the customer, or no matter it's retail or the wholesale. So what is the big change, brought from the introducing of the CBDC to the input of the game model? So, and also I want to know, so whether especially the MCBDC, they will bring any big change to the foreign currency transaction market. Yeah, thank you very much.
Okay, I'll give a shot at that. But I think on your gaming question, you mean, well, like along the lines of the conversation that Rodney and I had earlier, does the introduction by a government of a CBDC cause banks to rethink their strategy for how they offer payment services and how they price them? And I think it does. So from a viewpoint of the government, it makes sense to develop a CBDC. It's a good game strategy. And from the viewpoint of the banks, frankly, unfortunately, it makes sense not to do much until and unless you're confident you're going to get threatened. But in the meantime, to get ready. And some banks are probably getting ready right now. I would pick JP Morgan, which has a huge technology budget and is well aware of the potential costs of not acting. And other banks may be sleepier and not aware of the risks that they're going to get disintermediated by either a CBDC or a fintech payment service that could come along in the future. So I guess those are the main strategic issues. On the foreign exchange market, I think the MCBDC bridge, well, the foreign exchange market is already reasonably efficient in the interbank sense. It's only for bank customers that the profit margins are fairly high. And I don't think that's going to change very much necessarily. It might. The MCBDC bridge includes a corridor where there could be competition for foreign exchange, so that if your company wants to buy renminbi from Singapore using Singapore dollars, in the corridor, they could set up an auction market, and banks participating in the corridor like ICBC and Standard Chartered could compete by providing quotes for the exchange from Singapore dollars into renminbi. And that could improve competition. But so far, it's too early to say how they're going to set up that market. That's one possibility that's been discussed. But the foreign exchange market in the interbank sense is already fairly competitive.
Okay, thank you very much. Thank you.
Okay, let me conclude. Thank you, Professor.
Everyone to today's session with Cindy Young, Managing Director of Europe for, I suppose, one of the world's leading blockchain and crypto enterprise companies, Ripple. So thank you very much for joining us, Cindy. I mean, look, for those who don't know yourself or don't know Ripple, would you like to give us an idea as to what you do?
Yeah, thank you. Pleasure to be here. Thanks for inviting me. Yeah, so I'm the managing director of Europe for Ripple, so general oversight of the business based out of London, and we have a small office in Reykjavik, Iceland as well. And Ripple is a private blockchain enterprise software company. Essentially, we've started on a journey to basically make payments, cross-border payments, particularly much more efficient, transparent, cost-effective, basically more sort of fit for today's world by using crypto and blockchain technologies. And we're also going beyond payments as well.
Great. Listen, thank you very much for that. And on the topic of payments, I suppose we might start off there, and kind of collaboration between banks and fintechs. You know, I suppose in my own view, you know, banks have been very slow to adopt faster ways of facilitating payments. Do you think, you know, collaborations with fintechs are improving? And you know, they're becoming almost their own banks at this stage. You see the likes of Revolut and other players to the market, and you have to ask, you know, are banks really at risk of being left behind in this technology arms race? What's your view on that?
Yeah, I mean, I think collaboration certainly has been around for a while, but I think the stakes are definitely increasing, and I think those essentially that don't pursue collaboration will be left behind. And it's really a competition and collaboration, right? I think that's kind of the new trend. I think the reality is the current financial system hasn't really been updated in the last sort of 50 plus years, but consumers today want speed, reliability, and COVID also has just speeded up, right? This move to digital payments. And really only in the last couple of years, we've kind of seen this opportunity to really update infrastructure properly with rather than just a sleek front-end development, which I think what some of the kind of fintechs more focused on. And I think I just seen like a Accenture report actually, which suggested by 2025, right, banks will lose out about 280 billion or so in payment revenue due to competition from these digital payments players and other non-banks. And increasingly banks are partnering with fintechs, and essentially the fintechs have more ability to move faster, and banks benefit from the sort of new technologies and the use cases they bring about. I think, you know, certainly it is becoming kind of a no-brainer. I think one of the biggest changes here, I think, is that the incumbents, the bigger fives, I think they recognize that they cannot really rely on their existing market share today, right? As the world becomes more digitally native, mobile wallets are becoming more and more ubiquitous. Regulations like open banking are making it easier for tech companies, you know, to enter the markets and create more competition. And consumers, again, has much more information. They want everything more readily available. And I think, you know, with the advent of this kind of newer technologies, blockchain, crypto, finding new use cases and really changing the financial system, I think that collaboration becoming more and more front, because, you know, a lot of the traditional banks don't really have that expertise, worldview, use case, understanding. And more we're seeing that they're looking at players kind of sometimes like Ripple, right, who have experience in that area to help them on this journey.
Yeah, and look, you know, you said a couple of things there that just caught my interest. So one of the aspects you said there, those who don't collaborate will end up being left behind. And you spoke about, I suppose, that 280 million figure that effectively banks are leaving on the table, just being squeezed out of the market and not collaborating or not, I suppose, adopting fast enough. Have you seen, you know, in terms of, you know, your own industry and areas where Ripple are involved in, you know, what are banks most keen to collaborate on at the moment? And is there a particular pain point fintechs are solving for them?
Yeah, I think sort of more sort of a bit more generally, right? I think what fintechs typically offer to banks or more to traditional players are agility, right? Number one, in terms of like the operating, decision making, cutting edge technology. Again, it's quite hard to develop that in-house. I think for their much longer development cycles, etc., and more sort of innovative problem solving that is very centered around the customer, right? Like a lot of if we look at a lot of the fintechs, you know, how they came about, they started saying, look, there's a very specific customer problem for a very specific segment. We want to solve that. We want to be the best in solving that. And so they really bring that customer centricity. Whereas banks, you know, they don't have all the best things, right? Banks and all the traditional players, I think, offer more, definitely a large customer base, right? And a big brand. I mean, even through COVID, interestingly enough, a lot of people, I mean, there was a big shift to digital, but there was also still a big shift to bigger banks, bigger names, because of that trust that's been sort of built there. I mean, regardless of the financial crisis, etc. So this trusted brand credibility, I think, is really important, essentially, where, as you know, people, this is where they park their money. Yeah. And I think where banks really bring an amazing amount of expertise is this more sophisticated compliance and risk management practices, which is very, very hard for the fintechs, like, kind of to get on. You know, they're playing in the same sort of regulated environments. Stakes are high, right? If they get things wrong, fines, etc., reputational damage. So I think the two sides essentially bring a very complementary expertise and experiences and skills. And, you know, essentially kind of speed to pivot, going after emerging use cases are, you know, are a plus for nimbler startups. But they have to also, you know, they can't focus on always next shiny thing. They have to be very focused. Yeah. Essentially, I think those partnerships enabled basically, you know, banks and fintechs to bring 1 + 1 = 3 in a way, to really create a sum that is, you know, greater than greater than its parts. And especially when, you know, in today's world where consumer demands are changing quickly, businesses are also kind of following closely the consumer demands we've seen reflecting even in the B2B world. So in order to move so fast, I think those partnerships create a very unique opportunity.
Yeah, no, for sure. And again, you know, you touched on a few aspects there, because one of my questions to you was going to be around, I suppose, you know, what's in it for the fintechs? And, you know, you touched on that really, where, you know, we have banks that, you know, have a large customer base and a large brand and have an awful lot of that infrastructure that fintechs, you know, can help develop. But I suppose, you know, where is the ultimate value of that partnership, for fintechs in the long term? Because I suppose, you know, with the level of innovation that's happening, you know, in the fintech marketplace over, you might say, kind of your traditional banking marketplace, the balance of power seems quite symbiotic at the moment. And there's, you know, it's a good environment for partnerships. But it might be the case in a few years' time when the balance of power maybe starts shifting towards the fintechs as well, you know. So, you know, where do the fintechs see the value in all of this?
Yeah. I mean, the balance of values is quite interesting, actually. It's kind of a little bit back and forth, right? So I think as in the phase of kind of over the last kind of 10 years or so, as the fintechs were sort of ramping up, there was always this like, are banks losing out? And then open banking kind of regulations, PSD2 sort of coming about as well, and the likes of it. You know, it's a much bigger trend than Europe, UK. Again, there was like, oh, are they going to eat the banks, you know, lunch kind of discussions. But I mean, in reality, what we've seen is like everybody in a way found their kind of own area and where they add value in a way. And, you know, we haven't seen, yes, I think the fintechs and neobanks eating some of banks' lunch. Yeah, in some ways, you know, for sure, in some ways where they can bring, you know, greater efficiencies. But is it, you know, everything? Have banks disappeared? No, that also not the case, right? So it's a bit of a more middle ground, I would say. And also like fintechs have, you know, as they start out, right, as particularly they need to build a brand, they're trying to grow as fast as possible before running out of cash, right? Partnering sometimes with a bank, one gives them access to a much wider customer base, brand credibility to start off, you know, with that, you know, ramp up very, very quickly before they run out of money. And a lot of times, again, there's some profitable challenges with, you know, that the neobanks are facing today, especially through COVID, that kind of exacerbated. So yeah, it's not such a, you know, easy one. And I feel like the weight is going back and forth sort of between the two. But I think particularly one thing to add is, especially when there is a kind of a topic of like adopting the new emerging technology in the sector, right? I think we've seen that, for example, with like artificial intelligence, and in a way similarly with crypto and blockchain as well. What happens is, you know, over the last 18 months, all of a sudden, a lot of the, like, you know, institutional investors, from retail investors, institutional investors started showing interest. And then now every single bank pretty much is trying to figure out their crypto strategy, right? Like the amount of sort of digital asset reports that's just been published in the last just 6 months is just, you know, insane from before, where, you know, they wouldn't even talk about it. and more, you know, they're looking for partners again to kind of lead the way, understand the space, understand where they can lead value. And where I find this, for example, like fintechs who have the experience not only in the crypto space but also working with enterprises, which essentially, I mean, what we do with Ripple. I think there's kind of a positions that's really well in an interesting way with those banks that, you know, might have said, oh, I don't want to talk about crypto now, but now almost like knocking on the door is like, well, actually, you know, let's talk about, let's see where there is value. So especially in that area where it's about adoption of an emerging technology, I see it especially unique situation or, you know, a productive sort of environment for fintechs and banks to collaborate.
It's funny, you know, kind of speaking about the blockchain and crypto space, you know, the early adopters of, you know, 6-7 years ago are you know, having a good laugh at everything now from the parade. You know, it's fascinating to watch, and you know, there's always been an interest, I think, from banks and the corporate innovation sector, and taking, you know, kind of younger kind of fintechs, helping them grow, mentoring, obviously giving them access to a lot of what you're outlining there, Sandy. And I've always just kind of, you know, aside from those now trying to get in a little bit later stage into crypto and blockchain, you know, how does this impact, we'll say, in, you know, you've got a lot of banks that partner with fintechs very early on in the journey. You know, there's an M&A scene that comes in as part of that. You know, you spoke about how quick the landscape is moving. You know, how do you ensure that it's a win-win for both parties, taking into account just how quickly everything is moving? You know, how the banks may have, you know, partnered with a fintech 3 years ago, and that technology might already be redundant. You know, where's the win-win?
Yeah, absolutely. I mean, I think so. I mean, first of all, you mentioned kind of a bit around the M&A, I think, right? I mean, that's the, you know, I think the natural sort of cycle, you know, evolution of the industry. Of course, there might be some concerns around sort of, you know, anti-competitive behavior, but, you know, among company accumulating too much power, unfair competitive advantage, etc. But obviously, the competition authorities are, you know, watching out for things like that, which, you know, we've seen one of the big ones, I guess, Visa Play deal falling through earlier in the year. I think for larger companies, a FaÉtes acquisition is certainly a growth strategy, right? It gives them those sort of technologies. But precisely as you said, right, I mean, you can't just, you know, buy up a company today and expect that that's going to set you up for success for the next 10 years as well. It's always evolving. And we've seen like a lot of traditional kind of financial companies have also created venture arms. They have like these fintech ecosystems that are also, again, different ways of keeping them close to what's happening in the market and find the right time and opportunity, because there's not one partnership whether that works, right? Sometimes it's an acquisition, sometimes it's a joint venture, sometimes it's just a specific project, sometimes it's just using technology. Like there's so many different ways of looking at it. I think, I mean, in terms of the win-win, right? Again, I mean, there's not one solution, but essentially, I think one of the key things is, you know, as always, like start with the end in mind, start with the key objectives and make sure the parties are aligned on what they're trying to get out of that partnership, whichever shape and form it is. Sure. And the second thing that I have seen in my experience can be a make and break is really kind of like the cultural fit and how they approach customers, how they approach the world, how they approach that particular technology space. Because if that alignment, strategic alignment is not there, it's very, very hard to, you know, make things work. There's obviously going to be a ton of issues along the way to be resolved. I think that alignment really, particularly at the exec level, really makes a difference. And it's, you know, and I would think that just the third thing to add around the win-win is, like moving, being agile, moving fast, and keeping always an eye on the market, I think is very important, because again, these are not static things, right? Even if you create that partnership, you have to continuously nurture it, assess it, solve problems, you know, it's just like any relationship. Otherwise it will, I guess, die out and not deliver the benefits it's meant to be for everyone.
And you know, of course, with all of you know, I suppose these relationships and new companies emerging, new positions being taken by some of the more traditional banks, you know, you're going to find, you know, some examples of unexpected partnerships as well as part of that. Have you got any examples of that? And you know, where does Ripple come in as part of that, or what does that mean to you guys?
Yeah, I think, I mean, it's quite interesting, I think, to our, like, the earlier part of our conversation, right? In a way, this like partnership with partnering and collaborating with your competitors is almost, I think it kind of used to be considered the more unusual, but it's almost becoming like the normal thing, right? Or sometimes we call it as co-petition as well. I mean, especially I've seen that in the, like for a long time, sort of the industry was watching when and how the big tech companies, you know, would make more inroads to financial services or payments, particularly as they are doing more and more activities there. And then, like, we didn't see the big tech sort of, you know, getting banking licenses. Instead, we saw them doing a flurry of partnerships, right? Like there was Google City MasterCard. They launched kind of a sort of mobile checking savings account. Apple did one with Goldman for the Apple Card. Again, Amazon Goldman partnered to offer like Amazon sellers some credit line for the Amazon sellers with Goldman's Marcus brand. So there's been like a series of these, I think, happening, which are kind of, you know, at the time it was unusual, but now it's already like a year or two and it's not unusual anymore. And I think even similar, like in the crypto space, it's all about sort of pushing the envelope. And from, again, the banks who were kind of maybe in the earlier days, kind of, you know, shying away from the space is now coming back and looking at partnerships. Like, I mean, today we have a partnership with like Bank of America. I know JP Morgan works closely with Consensus. And I think for me, like one of the very interesting cases or examples, like in our experience at Ripple is SBI in Japan, which is one of the like massive, it's you know, largest big FIs in that market. And we formed a joint venture with them in 2016, right? Like this is a very traditional sort of, you know, financial institution. They had, you know, a big umbrella of solutions, consumer facing apps, various business units, etc. And we joined this joint venture is essentially to offer our sort of cross-border payments sort of exclusive in that market. And what happened is, like, we didn't actually start with a crypto-based solution. It was actually a, you know, sending money fiat to fiat, you know, across the network, but in a more efficient way. But we grew over time, right? Like, again, as the market developed, as we got closer, as you know, we were able to explain the value prop around the crypto-enabled cross-border payments. Eventually, like, they've moved, and last year we've just launched basically that the first kind of corridor between Japan and the Philippines, which means you can basically instantly settle, you know, payments from Japanese yen to Filipino peso in that market using the XRP digital asset as a bridge between them. Again, in 2016, that wasn't obvious that, you know, that was going to happen, but it's about investing. It's about having that foresight of what is possible and what can come. So I always kind of like to, you know, share that experience, something unexpected at the time. Now it looks very obvious and normal.
It's creating a world of possibilities, and you know, help. Like, and we always tend to forget that, you know, when we talk about money and payments, that there's real people behind all of that, and it's, you know, it really helps people in the, you know, like best and worst of situations. So Sandy, listen, thank you very much for your time here and your insights. It's been a real pleasure to talk to you about, I suppose, the future of collaboration between banks and fintechs. And I think the landscape that you've outlined to us, you know, certainly those unexpected partnerships with fintechs, I think we look forward to